So see that wick right here? We're hovering right around the halfway point or consequent encroachment. The fact that this candle closed above it, I would like to see it not trade back down to the lower end or lower half of that wick. I'd like to see it expand up and drive into that level right there. And we're on a 5-minute chart, so okay, see how we're hovering around that? This candle closed above it. When I see that and I have an objective or a draw on liquidity that's likely to be a reason for the market to want to draw up to, and this is reversed too for when I'm bearish, and there's a big candle like this. When I see that, and then the very next candle I'm watching, whatever the time frame is, it's all respective to whatever time frame you're watching. So it's not limited just to a 5-minute chart. It's universal. It's something that I would expect in reading any time frame. So if I'm watching like a 15-second chart, whether I'm watching a 1-minute chart or an hourly chart, whatever time frame, if I have the draw on liquidity in mind that I'd like to see deliver, if that's what's in my mind, I think it could reach for, and we see a wick like this, many other traders would see this as scary and problematic, like it could potentially start to reverse. I don't subscribe to that view, and I get further along in my belief that the algorithm will reprice to those buy stops here. If this candle that's immediately after the wick forms, if it can close above the midpoint of that, it just means that there's potential for follow through. Now, there's two things you can do with that information. You can do it as if you're a real short-term scalper, you can do things like this. Watch, I'll go into a 1-minute chart. And while price is hitting this right here, a real small, ultra short-term, high-frequency trading algorithm would be to be buying it when it hit here, and then using this high as your target. Just do like a half a point, since we're doing futures, like a half a point below that, your limit order would be there. And that in itself, you're doing more than most people on social media if you could just do that. And most people don't have an ability to find where price should gravitate to, where it should turn around, what real support resistance would be looking like. And if you follow the stuff that's in books that classically define support and resistance, that to me is that's random, okay? Because there's so many different interpretations of what support and resistance should be, and they don't all behave the same way. And one of the things that I tried to do over the years is to try to create a language where I can communicate to myself in my journaling, and also when I was younger, expecting to be a father at some time, right? If I had children, how could I talk to them and communicate a way where these candlesticks tell a story and there's a narrative behind what it is that they're doing, and that way we don't fall victim to just moving around for the sake of short-term randomness. Because I do believe, like, in very small time frames, when in consolidations, that's where, I guess, quote unquote, randomness can occur, because during those periods it's time distortion. And time distortion is where the market is not being permitted to move. It's not being allowed to displace higher or lower and start running. So in these very small time frames, sub 5 minutes or whatever, and you get these little consolidations in price action, that is time distortion. It's being held for a news event to hit the marketplace. It's being held for a session close. Like if you watch how the last few minutes of trading, after 4 p.m. in the New York session, many times you'll see the market just start marking time, basically just going sideways, isn't doing anything. That's time distortion. The algorithm is not operating anymore. It's just they set a range high and they set a range low, and they just let it meander back and forth. It's not seeking liquidity there. It's not going after anybody's stops. Buying and selling pressure has no influence over it. It's just simply limiting its range in delivery. That's it. It's done. But during market hours, the algorithm will absolutely be seeking liquidity it will be running off of macros. These are short little scripts in market code, okay? And all these things will be firing, causing price to move, and it has nothing to do with how many people bought it or how many people sold it. All right, so look at the reaction there. We went just above that wick here, just by a little bit. We're pulling back. And now look at all of this run here. Look at all this price delivery right there. Is there any inefficiency? Let me make it a little bit larger so you can see. From this candle's high right here down to that low, is there any inefficiencies in price? Fair value gaps is basically what I'm saying. From this candle to this candle, no. From this candle to the left, no. From this candle to the left, no. From this candle to the left, no. From this candle to this, yes. You see it? That small little one right here. See that? This is the only inefficiency in this price run here. This one's kind of like the same. Let me see what the high is on that one. High is 80.5. Low is 8, and it's even. So there's no inefficiency or no gap there. So it's an immediate rebalance, which is perfect for me to segue right into that. Started the run here, open, traded down. Whenever we see this is one of the things I teach. It's an immediate rebalance. That is an immediate rebalance. That means it's as soon as it does that, you're going to see sudden price delivery, real quick. You tell me. Okay, does that look like it once it gets somewhere after it did an immediate rebalance? Of course it does. Where's it going to go to? That high. We can anticipate an entry here, a pyramid entry here, or if you missed this run, as I outlined live, that it's consolidating around that consequent encroachment of the higher time frame candlestick wick. That's what I was measuring on that. And came down, hit it, rallied up just to take out the high. It did so here. No inefficiencies at all. And I want to see, personally, I want to see price stay above consequent encroachment. That'll tell me this is where we're going to run for at the 930. If we break down below it, then it's probably going to need to trade into this area here, which is of no consequence to me because I could care less. But like say I was trading this morning and I wanted to trade the New York opening bell at 9:30 to 10 o'clock and I wanted to do something, okay? Or I wanted to tape read, okay? Or I wanted to do a demo account execution for practice and I don't want to take real risk. Or I just want to sit down. My youngest son's not with me this morning, but if I wanted to sit with him and practice executions or reading the tape with him, I would use the information I'm showing you here. For 930, for this run up here, the higher probability trade setup would be for price to stay, and it can do what it just did there. It can wick down below that, but just I don't want to see the close of that candle. See where it stopped? See that? See how it stopped right there? That's good. I like that. But if it traded down and closed below that, then this is a factor that needs to be revisited. But that right there, that close, and look at the reaction right there. That little response right there, that's an algorithm that's doing that. That's not buyers and sellers, okay? That's these things I'm talking about. That is a signature in price. And when you know where you're supposed to be expecting them to form, when to anticipate their delivery, what they should be performing, what should they offer in terms of support or resistance, should it incite the algorithm to start repricing to a specific direction or a specific price level, and these PD arrays in the right narrative, so that way when you understand what price is likely to do, it'll tell you how fast it should deliver. Like, should it be a slow meandering delivery where it just keeps on creeping, or does it go like, well, runs real quick and takes off? That part, like, I can't write a book that's going to be able to clearly show you that. Like, you have to see it live. You have to see examples of it. And when I do executions, even when it was in demo, the purpose is were for you to go back and study and see where those things are that repeat that I teach, and how is that used in price for that particular trade. What elements of the things that I teach in price action were in that trade setup that I took. I like the idea that this candlestick came down just about half of that candlestick. That would be mean threshold, because we're talking about a body, so it's not an inefficiency. But because it's Friday, because it's a day I'm trying to remind you not to take this stuff, because I know some of you right now are pushing buttons because you hear me talking, and you are being convinced that what I'm saying here is just enough for you to get into a trade. I'm telling you, don't do that. Don't do that. In a perfect world, it should run higher right from here. If it were, say, it was a Thursday, not Friday, I would already be net long, and my limit order would be just below here, and I would have a best case scenario up into this up here. That's how I would handle that. But it's Friday. I'm not trading it. I'm not live. You're not going to have here's a dose. I was secretly doing my trade. I'm not doing that here. I'm just telling you how to read, how to practice it, and use the day without taking on risk. The best case scenario would be to stay above in this range here prior to 9:30. And if it does that, then I would like to see price run this area here at 9:30 or just after 9:30, going into 10 o'clock. But then at 10 o'clock, I think that we could see it retrace, throughout the remainder of the PM session and go lower and attack all the price delivery that we've seen so far from the London hours all the way through to pre-market. So a lot of things you got to weigh out in it. That's why it's difficult. It's the hardest easy money you'll ever make. Now, another thing for your notes today, whenever you have two high impact news drivers, whenever there's two high impact news drivers in the same session, like we have an 8:30 news driver that just has already hit the market at 8:30, and then we have one at 10 o'clock. Whenever that happens, whenever that's in the economic calendar, my mind immediately goes to, in case you're wondering, like, why would I say 10 o'clock news should be used to go against everything that's going on? Think about it like this. If a terrorist was going to lay a bomb down, okay, and they do it this way. They go into a busy area where a marketplace or a storefront, and they set a small charge up. And when that charge goes off, what's going to happen? Everybody's going to run away from that point of impact, right? And they all run to a location where the larger bomb is, so that way there's more casualties, okay? In my mind, the way I internalize what they do is much like what I teach with FOMC, much like I teach with non-farm payroll. Those are financial bombs, okay? They're literally placed in the marketplace. They're algorithmically delivered. And what happens is one news driver sends price, careening one direction. That's that first explosion. Okay, so at 8:30, what did price do down here? Running, right? We have a potential pool of liquidity up here where price could gravitate to, right? And I'm suggesting to you, as long as we're in the upper half, as long as we're in this area here, going into 9:30, I favor the idea that we could run up in here and sweep that out. And on some kind of momentum, overzealous price delivery, best case scenario would be up into this area here, this inefficiency on the higher time frame. But I'm not willing to take that trade today. Hearing me talk about it live over the chart, that way it gives you a little bit more understanding of why I'm not taking the trade, but I'm also using the opportunity to teach you real time what I would do if it was, say, like a Thursday, where it wasn't the end of the week, okay? But that 10 o'clock news driver and price running up to this level here and maybe, spiking up beyond it to get into this inefficiency here, I would use, if I was making the market, I would use the 10 o'clock hour, that news, and the sentiment after seeing traders see it rallying from 8:30, and at 10 o'clock, we see it going higher. What is the public going to do? What's the street money going to be thinking? Street money is going to be like, I want to be long, right? I want to be long. That's the very logic that I used on Wednesday to explain to you why we're trading where we're at right now through Thursday and now Friday's initial trading. Because I'm waiting for those wrestling matches when the sentiment of retail, the collective that is called retail trading, the street money, the quote unquote dumb money, and I don't mean that to be ignorant, but that's just what it is. I mean, I came from that too, right? Everybody is that when they first start. I'm waiting for the time period where what I'm anticipating that the algorithm will do, how it runs on specific narratives and its macros and the time of day it does certain things using the economic calendar, just like a TV guide. Okay, you can anticipate the sentiment shifts that the retail trader and collectively the traders will think and how they will perceive price before it even happens. So you're really not only predicting the future, but you're reading other people's minds in the future, which is an amazing skill set to have. And that's why this industry is so fascinating, because it's really a study of psychology. It's more a study of psychology than it is of a game of chance or risk. And I think if you approach your initial stages of learning with that mindset, that approach to internalizing how price is being booked and why it would be booked like that, what would be the instigation of price doing a specific thing? What would be the catalyst? What would be the driver of it doing that very thing? What would be the cause and effect? What would be the repercussions of price doing a very specific thing? And how would the losing crowd, the retail-minded trader, how would he fall victim to it? Because that's what this game's about. Every large fund manager is still a retail trader. They're literally trading with retail concepts. It's amazing. When you sit down and see what they're doing the same stuff that everybody has in these books. They're just doing it on a larger scale, on the higher time frame charts, and just allowing for more time to eventually move the market in their favor. That's all that's happening. Now, the proprietary firms out there that have their own algorithms that they're running in the marketplace that trade off of small short-term fluctuations in price action, they are not using retail logic. They're using a lot of the things that I'm talking about here today. The framework is around how they can get in, take bite-sized pieces. Okay, there's a fish, and I may not be saying it accurately. I don't know if it's considered a small shark or whatnot, but in the ocean, there's this little tiny, I'm just going to say fish, okay, but it might be technically a shark. What it does is it runs up real quick on everything out there. It'll do it to a killer whale. It'll do it to a blue whale. It'll do it to a shark. It'll do it to a paracuda, any fish, a tuna. But it runs up real quick and bangs into it, and it takes a perfect circular bite out of them. And that's all it takes. Hits it, runs. And you can see other fish and other living organisms in the ocean that have been eaten by this thing. They're not consuming the entire thing. And the wound isn't many times a fatal wound, but they're losing a piece of themselves. And they sustain themselves by simply going in and getting one bite. That's what these proprietary algorithms do. They go into the marketplace to take these little bites here and there at points that when the market makes it available to it, it will work and engage it that way. Whereas a long-term large hedge fund manager, they're not looking for these little surgical strikes. They're looking for big, long-term, massive price swings because they don't want to have their clients constantly calling up, hey, what are you doing? Like, my equity's going up and down a lot. They don't want that. They want a very, very slow, smooth equity curve. And if it takes all year long to get 15 to 25%, that's exactly how they want to engage price. They want to engage and utilize their assets under management like that because they don't want their clients to be hopped up on goofballs or fearing and freaking out because of the normal fluctuations in price action.